Fund I was the proof. Fund V is the continuation, this time with bonus depreciation and with a high-powered team behind it. The fund consisted of $15 million of capital from myself and the investors. The fund gross IRR, or the annual average return, was 38.3%, and we returned $25.56 million over the life of the fund back to the limited partners. The fund's average cash-on-cash return was a really strong 14.2 annual percent. And the best part is the investors didn't have to wait to year 5 to get their returns. Patriot started initiating distributions right after year 1, and they came early and often. The fund strategy is different because we focus on alternative commercial real estate assets. That's acquiring mobile home communities and self-storage facilities. We executed quickly, between 12 and 36 months. We bought the asset and then started driving rents up immediately. Started making the capital improvements like paving, painting, lighting, fencing, signage, advertising, new management, driving performance of NOI through management inefficiencies. And our targets were very strategic. We looked at assets between $1 and $10 million. It's a 5-year fund. We bought the assets within year 1 and 2, and we executed on the business plan by year 3 and 4 and exited completely out of the fund by year 5. But along the way, we were selling assets in years 2, 3, and 4, increasing investor returns, helping them get their capital back, and then accelerating their cash flows with the assets that we had remaining in the fund. We started returning significant amounts of capital between month 12 and 18, and we sold 12 of the 20 assets by the end of year 3. This helped drive investor cash flow, averaging that 14+% cash-on-cash return year over year. Selling assets in a high interest rate environment and still executing and generating large returns. Because we executed on the value add plan, the exit cap was an astounding 4.62% on average across the assets. This really proves that Patriot built value, not just bought into it. So what's next? Patriot Fund V is the current fund that is the exact same strategy as Fund I. We're focused on buying storage and warehouse properties and affordable housing, manufactured home communities. So what's changed? Well, in Fund V, we've elevated the team. We have direct leadership and asset management driving performance, looking at the little details and making sure we hit our targets on time, on budget. In terms of deal flow, we're still cultivating the same database, building relationships with 5,000 choice sellers that fit the mom and pop mold of inefficient assets that we can buy at a bulletproof basis. And now the competition has been diminished. Other sponsors have been exiting the space because it's a hard business to manage. This is not just real estate investing or capital allocation. This is execution of a business plan. And this time around, I've learned from my mistakes. I know exactly what to look for with assets that we don't want to buy. We're diligent in what we say yes to, and I'm saying no 99% of the time. We are not forecasting large rent growth or compressed cap rates. Conservative numbers so we can hit our investor targets, even in a down market. And this down market is an advantage. High interest rates allows us to buy assets at a great basis. And we're entering into a landscape where interest rates should be compressing, but we're not counting on it. So we're buying off of true cash flow today, not on interest rates lowering or a cost of debt being reduced. So click the link, schedule a call, no pressure. I hate pressure sales, just perspective. So the main goal is just to see, does Fund V make sense for you right now with your financial situation? And my job is to continue to find great real estate deals for you.